Welcome, deep divers. Before we plunge into today's analysis, just a quick word from Stock Analytics AI. Want more deep dives like this one? Members get priority access to our upcoming S&P 500 series. We're covering every single stock. It's just $4.99 a month, so you can get ahead of the curve. Or, if you have a specific ticker in mind, just drop us a super thanks for a one-off request. Okay, let's dive in. What if the answer to, well, decades of failed Alzheimer's and Parkinson's drug research isn't really about attacking just one rogue protein? What if it's about fundamentally restoring the brain's entire information highway? Today, we're diving deep into a company that's betting its entire existence on that very idea, a company that believes it can succeed where giants have stumbled. It's genuinely one of the most polarized, high-stakes investment cases we've ever looked at, and by the end of this deep dive, you'll understand why it could be either a massive win or, frankly, a complete write-off. You're listening to The Deep Dive, where we cut through the noise to get you well-informed and fast. Our mission today, to thoroughly explore Annovis Bio, Inc. That's ticker ANVS on the NYSE. It's a clinical-stage biotech company tackling two of the most devastating neurodegenerative diseases, Alzheimer's and Parkinson's. We're here to unpack its unique scientific approach and, crucially, the immense risks and rewards involved. Just so you know, our analysis date is August 22, 2025, and Annovis Bio's share price on that date was $2.49. Pretty low.
Yeah, and we'll navigate this really high-stakes landscape by breaking the company down piece by piece. We'll start with its core business, management, financial health. Then we'll shift to market sentiment, ownership, and those critical risks. Our goal is really to give you a complete picture, helping you understand not just what Annovis Bio is, but why it represents such a unique, potentially transformative, or, let's be honest, incredibly risky opportunity.
Okay, sounds good. Let's kick things off with our first segment, Chapter 1, Business Analysis. So what exactly is Annovis Bio at its core?
Okay, fundamentally, Annovis Bio is a pre-revenue clinical stage biopharmaceutical company. And for you as an investor, this is absolutely crucial. Its value isn't based on current sales or profits, none of that. It's purely on scientific and regulatory milestones.
Milestones
Like positive clinical trial data, getting new patents approved, having successful meetings with the FDA. That's what moves the needle.
Right. So no current product sales. That means they're completely reliant on external financing. How sustainable is that, really?
Well, that's the million-dollar question, isn't it? They fund operations mainly by issuing new shares and warrants. It's only sustainable as long as investors keep believing in the science and those milestones keep coming, which is why every single positive data release or successful FDA interaction is just so vital. It's what drives their perceived value, you see. Without those, raising more cash gets a whole lot harder.
Makes sense. And the company's fate seems almost entirely tied to one key product. Buntanetap. That used to be called Posifen, right?
Exactly. Buntanetap.
Yeah.
And this is where it gets really interesting. Its unique mechanism of action, its MOA, is the potential game changer here. It's an orally available small molecule drug. And it's designed to inhibit the creation of multiple neurotoxic proteins simultaneously.
Multiple, not just one.
No, not just amyloid or just tau. It attacks, the production of all the key problematic proteins implicated in neurodegeneration, amyloid, tau, alpha-synuclein, and TDP-43. This sort of broad-spectrum approach is what makes it so distinct and potentially, so powerful compared to those previous, often failed single-target strategies.
That analogy you used earlier is great. If the brain's neural network is an information highway, these toxic proteins are like massive traffic jams, right?
Precisely.
And buntanetap acts more like a central traffic controller, normalizing the production of several troublemaking proteins all at once. So the idea isn't just to halt damage, but maybe even restore nerve cell function. That feels like a really fundamental shift.
It is. And the market opportunity for this kind of potential breakthrough is just enormous, staggering, really. Annovis is a small-cap biotech, only a $48.5 million market cap right now, yet it's addressing this immense unmet need.
How big are we talking?
In the U.S. alone, you've got 6.9 million people with Alzheimer's and another million with Parkinson's, and those numbers are projected to grow significantly in the coming years.
Wow, a multi-trillion-dollar potential market then. It's pretty striking how lean Annovis operates, though. Just 8 employees?
Yeah, 8 employees. They primarily outsource their research and trials to contract research organizations, or CROs.
So how does this incredibly lean structure affect their ability to stand out, especially against giants, given the scale of the problem they're tackling?
It forces them to be laser-focused, very strategic. Buntanetap's differentiation has to be crystal clear. First, the multi-target mechanism, addressing the underlying cause. Second, it's an oral, once-daily pill. That offers huge advantages in convenience, cost, and, patient compliance compared to IV drugs like Leqembi.
Convenience is key. Absolutely.
And third, crucially, it has shown a pretty well-tolerated safety profile in trials so far. Notably, it seems to avoid ARA,
ARA. Remind me what that is.
amyloid-related imaging abnormalities, basically brain swelling or bleeding, which has been a real issue with some other anti-amyloid antibody drugs. Avoiding that is a big plus.
Got it. And the industry context here is just brutal, isn't it?
No, absolutely. You have these two powerful opposing forces,
Yeah.
this immense demand for a cure or even just a good treatment.
Versus incredibly high clinical failure rates. What were those numbers again? Like 2% success for Alzheimer's drugs historically.
That's right. Only 2% for AD and maybe around 15% for Parkinson's. It's a real graveyard of good intentions and billions of dollars.
A graveyard, exactly.
And it's this landscape, especially the recent failures from big pharma giants like Roche and Johnson & Johnson, discontinuing several single protein targeting programs in 2024 that actually indirectly supports Annovis's whole multi-target thesis.
Right. Every time a single target drug fails, it kind of strengthens the argument for a broader approach like theirs.
Precisely.
Okay, but what about the regulatory side? The FDA path is always long and tough.
It is, but Annovis has some good news there. A favorable end of phase 2 meeting with the FDA for Alzheimer's. They basically aligned on a path forward for phase 3. The FDA raised no major safety concerns, and they even got approval for a new, more stable crystalline form of buntanetap.
That does sound like a significant de-risking event. Getting the FDA on board, even preliminarily, is huge.
It absolutely is. These are critical signals that the regulatory pathway, while still long, is at least becoming clearer, vital for any biotech.
So, tying this together for competitive advantage, their moat, so to speak, it seems to rest squarely on these unique assets and capabilities.
Yeah, and the barriers to entry in this space are just immense. You need incredibly complex science, staggering amounts of money, often over $1 billion to get a drug to market.
$1 billion. Wow.
And you absolutely need strong intellectual property.
And Annovis has that.
They do. Their primary asset is a pretty formidable patent portfolio. We're talking 13 patent families protecting buntanetap, its mechanism, its use, all the way out to 2046.
2046, that's an incredibly long runway. That protection seems solid.
The patent protection is definitely a strength. But the real engine of future value, their core capability, is that novel multi-target scientific approach itself.
Yeah.
That's what truly differentiates them.
But even with the patent and the novel science, they still need the money or a partner to actually cross the finish line, right?
Exactly. The patent protects the idea, but execution still requires immense capital or a strong partnership.
Okay, let's shift gears from the science to the people driving it. Let's dive into Chapter 2. Management evaluation. Dr. Maria Macchiachini, the CEO, she's been there since 2008, a 17-year tenure. That shows serious commitment. What else do we know about her track record?
Well, a really crucial data point here is her prior success. She founded a company called Symphony Pharmaceuticals,
Symphony, right.
which she successfully sold back in 2001. Now, this history suggests a leader who really understands the full life cycle of a biotech venture. Not just the early science, but getting it all the way to monetization. That adds a lot of credibility.
That's a key point. Experience in actually exiting a company successfully. And the broader team.
The broader team also brings seasoned experience in critical fields, neuroscience, chemistry, regulatory affairs. It seems like a solid group for this stage.
And it's worth noting, management has seemed pretty consistent in their strategy and how they communicate, even when the stock price has been volatile.
Very volatile, yes. And if you look at their implicit business strategy, it really seems geared more towards an acquisition or maybe a partnership down the line, rather than trying to build a huge integrated pharma company themselves.
Which aligns with the CEO's history and that lean 8-person structure we talked about.
Exactly. It fits the pattern.
And looking at capital allocation, it's basically 100% focused on R&D, like that $20 million spent in 2024, and the necessary G&A, general and administrative costs. No M&A strategy for buying other companies.
Right. And it's important for listeners to understand that a deeply negative return on invested capital, or ROIC, their ROIC, is like negative 186.93%.
Minus 187%.
Yeah, it look awful on paper, but it's entirely normal, even expected, for a clinical stage biotech. It just reflects those necessary R&D costs before you have any potential profit.
So not a red flag in itself at this stage?
Not in itself, no. Similarly, no share buybacks, no dividends, also totally appropriate. Their focus has to be on growth and getting that drug approved, not returning capital to shareholders yet.
Okay, that sets the stage nicely for our next segment. Let's turn to Chapter 3, financial analysis. As you said, for clinical stage biotechs like Annovis, you're not looking at traditional revenue or profit. It's really all about the cash burn rate and their financial runway.
Precisely. The company consistently reports zero revenue. Profit margins are deeply negative. Free cash flow is significantly negative. That's just the standard financial profile here. Their R&D expenses have fluctuated a bit, and their cash position has varied over the last 5 years. But the core story is consistent. They are spending money to develop their drug. They're not earning any yet.
Right. But while those consistent net losses are standard, there are some positive spots financially, aren't there?
There are. For instance, they have a 0% debt-to-equity ratio. They're funded entirely by equity, no debt hanging over them.
Which is good.
And they have a very healthy current ratio of 7.65. That indicates strong short-term liquidity. Basically, they have enough readily available assets, mostly cash, to cover their short-term liabilities several times over.
Okay. But here comes the but, right?
Yeah.
The big issue.
Here comes the big but. The most pressing financial reality is their limited cash runway. It really acts like a ticking clock, almost a doomsday clock, for the company's current cash pile.
How much runway do they actually have?
Okay, so as of March 31st, 2025, they reported $22.2 million in cash. Their operating expenses are running at about $6.3 million per quarter.
So quick math, $2,202 divided by $6, that's only about 3.5 quarters.
Exactly. Roughly 3.5 quarters. That suggests their current cash only funds operations into Q4 of 2025. That's the company's own guidance, too.
Okay, but wait. You said their pivotal phase 3 Alzheimer's data isn't expected until the second half of 2026.
Correct.
That creates a pretty significant gap, doesn't it? At least 6 months, maybe more, between when the money runs out around the end of 2025 and when they'll have that major new data that could attract fresh investment in late 2026. What happens in that gap?
Well, that's the critical financial overhang. Consequently, another capital raise and the shareholder dilution that inevitably comes with it, it's not just a possibility, it's a near certainty, probably in late 2025 or early 2026.
And that certainty of future dilution is likely a major reason the stock price is so low right now.
Absolutely. Investors are anticipating their existing shares becoming less valuable as more shares are issued. It's a primary factor weighing on the stock's valuation.
Which brings us to valuation. Traditional metrics like PE are useless here, right? Their PE is negative. Mine was 1.61.
Completely meaningless, yes.
They do have a price-to-book ratio of 2.65. Does that tell us anything?
It tells us the market values the company at more than just its tangible assets, which likely reflects the perceived value of its intellectual property, the patents. But it's still not the main way these companies are valued.
So how do you value a company like this?
The standard approach for clinical stage biotech is using a risk-adjusted net present value model, or RNPV.
Okay, RNPV. Break that down for us simply.
Sure. Basically, you try to estimate the drug's peak potential sales if it gets approved. Then you project the cash flows out over years. Crucially, you apply a probability of success, or POS, based on the clinical phase it's in. Then you discount all those future potential cash flows back to today's value using a discount rate that reflects the high risk involved.
So lots of assumptions there. What kind of numbers are we talking about for Annovis, just educationally?
Right, just for illustration. You might assume, say, a 55% probability of success for a typical phase 3 neurology drug, though that's debatable here. You'd use a high discount rate, maybe 15% because of the risk, and you'd plug in potential peak sales in the multi-billion-dollar range, given the market size.
Okay, so if you run those kinds of numbers, what does the model spit out?
Well, even with fairly conservative assumptions within that framework, an educational RNPV model would likely suggest an intrinsic value somewhere in the range of, say, $8 to $21 per share.
$8 to $21 per share. Compared to the current price of $2.49, that is a massive difference.
It's a huge disparity.
So what gives? What is the market seeing or fearing that makes it value the company so much lower than even a conservative RNPV might suggest?
This massive difference really highlights the market's profound skepticism. Specifically, skepticism about buntanetap's actual probability of success in phase 3. It strongly suggests that investors believe the chance of getting through phase 3 trials successfully and winning FDA approval is far, far lower than that typical 55% assumption we used. They are pricing in a very high risk of failure. That's the crucial takeaway here.
Okay, that's a stark contrast. Let's transition now into part 2 and delve into that market view. Chapter 4, Market Sentiment. As you said, the market perception for Annovis is really a study in contrast. There seems to be this massive chasm between Wall Street analysts and Well, the actual daily stock price action.
It's incredibly polarized.
Yeah.
On one side, you have the analyst community. They are overwhelmingly bullish.
How bullish?
We're talking a strong buy consensus rating, with 88% of covering analysts recommending buy. Their average one-year price target is around $14.54.
14.54 compared to $2.40. That implies what? Over 480% upside.
Exactly. But that optimism is clearly rooted in the forward-looking potential of the drug if it succeeds, not the current reality.
Okay, so that's the analysts. But then there's the general market, reflected in the stock price, which seems focused squarely on the immediate challenges.
Precisely. We've seen mixed news recently, some positive things, like getting that patent protection extended to 2046, getting their NYSE compliance plan accepted.
But also negative things, right? Like that $21 million public offering back in May, which caused significant dilution and hit the stock hard.
Yes. So the prevailing tone reflected in the stock's price is one of really deep skepticism. The market seems to be weighing the certainty of these financial challenges, the cash burn, the coming dilution, much more heavily than the very uncertain promise of clinical success down the road.
Can we quantify that skepticism somehow? What about short interest?
Ah, yes. Short interest is definitely telling here. It's high, sitting at 14.00% of the public float.
14%. So a significant number of investors are actively betting the price will go down.
Yes, actively betting against the company. They're likely anticipating trial failure or maybe just more damaging dilution from future capital raises. It's a clear indicator of negative sentiment.
And what about days to cover? That's relevant too, isn't it?
It is. The days to cover ratio is 9.16. This basically means at the average daily trading volume, it would take short sellers over 9 full trading days to buy back all the shares they've shorted.
So does that create a kind of coiled spring effect? Like, if there was good news, all those shorts scrambling to cover could cause a massive price surge, a short squeeze.
It definitely creates the potential for that, yes. A positive catalyst could trigger a significant short squeeze, amplifying volatility dramatically upwards.
But it's also a warning sign.
It's also fundamentally a warning sign. That high level of short interest signals that a significant portion of traders, often sophisticated ones, believe the downside risks outweigh the potential upside right now.
And the technical picture from the charts.
Oh, the technical picture is unequivocally bearish.
Or
The stock is in a severe downtrend. It's down over 74% in just the past year. It's trading far, far below its key moving averages, the 50-day and the 200-day. Those are typically seen as indicators of the medium and long-term trend.
And I saw the 52-week range was $1.11 to $10.54. So at $2.49, it's much closer to its annual low than its high.
Exactly. It reflects a market that has, at least for the time being, lost confidence and is really dominated by sellers.
Okay, a pretty bleak picture from the market's perspective right now. Let's move on to Chapter 5. Ownership structure. Who actually owns Annovis stock?
Well, institutional ownership by large funds, pension funds, endowments is relatively low. It's only about 10.88%.
10%. That seems low for a biotech, even a clinical stage 1.
It is quite low. And importantly, the largest holders listed are firms like Vanguard and Geode Capital Management. These are typically passive index funds that have to own the stock because it's in an index, not necessarily active specialist biotech funds making a high conviction bet.
So not a strong signal of smart money conviction from dedicated biotech investors.
Generally, no. It suggests a lack of strong conviction from those specialist funds that really dig into the science. And recent activity from institutions overall has been pretty mixed. Some buying, some selling, no clear trend.
Okay, but then you contrast that with insider ownership. That picture looks very different, doesn't it?
Very different indeed. Insider ownership is exceptionally high, somewhere between 28% and maybe up to 39.35%, depending on how you calculate it.
30 to 40% held by insiders. And the CEO, Dr. Machikini, holds a big chunk herself.
Yes, she holds a significant 5.72% stake personally.
Wow. Okay, so institutions are lukewarm, but the people inside the company own a huge amount. What's even more telling, though, are the transactions, right?
This is probably the most telling detail in the ownership structure, I think. There have been absolutely zero insider sales reported in the last 12 months.
Zero sales.
Zero sales. Instead, what we've seen is a consistent pattern of buying. Insiders have acquired over 78,000 shares just in the last 3 months alone.
Who's been buying?
People like board member Andrew Walsh, CFO Michael Hoffman, and yes, the CEO, Maria Machikini herself, have all been buying shares on the open market with their own money.
Okay, that feels significant. When the people who know the company best, who see the data first, are putting their own capital on the line, especially while the stock price is falling, That's usually seen as a very strong positive signal, right?
It's arguably one of the strongest positive signals you can find in analyzing a stock. It implies genuine belief from those with the most intimate knowledge that the shares are undervalued and the company's prospects are good.
Interesting contrast to the low institutional ownership. So who holds the rest?
The largest share, actually, is held by retail investors, individual investors like you and me. They hold about 57% of the company.
57% retail. What does it imply?
Well, a large retail investor base can often contribute to higher volatility. Retail investors sometimes react more quickly, perhaps more emotionally, to news headlines, both positive and negative, compared to larger institutions or insiders with a longer-term view. It adds another layer to the stock's inherent risk profile.
Okay, makes sense. So a very mixed ownership picture. Now, let's try to pull all the risks together systematically. Time for Chapter 6. Risk assessment. We can use a SWOT analysis framework here. Strengths, weaknesses, opportunities, threats. Let's start with the internal positives. Expert, remind us of the core strengths.
Okay, the key strengths we identified are that differentiated multi-target scientific approach, the robust intellectual property with patents running all the way to 2046, the exceptionally high insider ownership and that consistent insider buying pattern, and finally, the experienced management team, including a CEO with a history of a successful company exit.
All right. Now for the internal challenges. What are the major weaknesses?
The weaknesses are pretty stark. First, there's the complete dependence on a single drug candidate, Buntantab. If it fails, there's no backup plan evident right now. Second, no revenue and that significant ongoing cash burn. Third, the limited cash runway we calculated, funding operations only into Q4 2025. And fourth, related to that, the near certainty of significant future shareholder dilution from upcoming capital raises.
Okay, clear weaknesses. Now let's look outside the company. What are the potential opportunities Annovis could seize?
The opportunities are huge, really. First and foremost, that massive multi-trillion-dollar unmet medical need in the Alzheimer's and Parkinson's markets. Just enormous potential demand. Second, paradoxically, the recent failures of competitors trying single-target approaches could actually validate Annovis's multi-target strategy.
Makes their approach look smarter, potentially.
Potentially. Third, there's always the high potential for a lucrative acquisition by a large pharma company if the phase 3 data looks good. Big pharma often prefers to buy innovation rather than develop it internally, especially in risky areas like neurodegeneration.
And they could expand Buntantab into other diseases.
Yes, there's potential to expand into other neurodegenerative indications beyond just AD and PD, broadening the market opportunity further.
Okay. And finally, the external factors that could really hurt them. What are the main threats?
The threats are significant. The number one overriding threat is clinical trial failure for Buntantab. As we've said, it's a binary existential risk for the company.
Binary, life or death.
Absolutely. Second, the risk of being unable to raise sufficient capital or having to do it on really unfavorable terms that excessively dilute existing shareholders. Third, the possibility of unexpected safety issues emerging in the larger phase 3 trials, or outright rejection by the FDA even if the efficacy data looks okay.
And there was a geopolitical risk mentioned too.
Yes, a more specific one. They rely on a primary API supplier, but their backup supplier for the active pharmaceutical ingredient, the core drug substance, is located in China. This introduces geopolitical risk, particularly thinking about potential trade issues or tariffs, like those being discussed for 2025, which could disrupt their supply chain or increase costs.
Right. I just want to re-emphasize those two key internal risks again, that single point of failure with everything riding on Buntantab and the truly precarious financial position with that funding gap looming before the phase 3 data arrives. Those feel like the absolute make or break issues.
They absolutely are. This is genuinely a go big or go home situation for Annovis and its investors. The binary risk of clinical trial failure isn't just a potential setback. For Annovis, a negative phase 3 result would likely be terminal. It's the ultimate cliff edge. And you also have broader macroeconomic factors like higher interest rates potentially making it harder and more expensive to raise that necessary capital, layered on top of those specific company risks like the China API supplier issue.
Okay, a lot to consider there. We've covered the business, the management, the financials, the market view, the ownership, and the risks. Let's try to bring it all together now in Chapter 7, Conclusion. So what does this all mean for you, our listener, as you think about Annovis Bio? I think it's fair to say the investment case is one of the most polarized imaginable. It presents a really clear, compelling narrative for both the bulls and the bears. It's truly a quintessential high-risk, high-reward proposition, and everything hinges on a single binary outcome. Does buntanetap work safely and effectively in phase 3? Let's quickly recap the bull case. What are the key arguments for optimism?
The bull case rests on the novel multi-target science, potentially addressing the root cause of these diseases, the enormous multi-trillion-dollar market opportunity, strong IP protection locking things up until 2046, the significant insider conviction shown by consistent buying, plus management's history of a successful exit, and the potential advantages of a convenient, possibly safer oral drug profile. It's a powerful story of potential disruption.
A very compelling story if it pans out. But the bear case is equally forceful, right?
Absolutely. The bear case hammers on that huge binary clinical risk in a field notorious for high failure rates. The company's financial precarity, the constant cash burn, the short runway, the guaranteed upcoming dilution, and finally, the profound market skepticism that's clearly reflected in the stock's very low price and that high short interest, suggesting the market is effectively betting against success.
And the current share price, around $2.49, absolutely reflects that deep skepticism and the weight of that financial overhang we discussed.
It does. However, remember, our educational RMPV model, even with conservative inputs, it suggested a potential intrinsic value of $8 to $21 per share if, and it's a huge if, buntanetap succeeds clinically and gets FDA approval. That potential valuation is entirely contingent on those future events. The current market price is essentially saying that investors believe the probability of that successful outcome is very low, a real long shot.
So wrapping up, Annovis Bio is definitely not your traditional value investment. It's much more like a venture capital style speculation. You're betting on a binary scientific outcome. It offers the potential for multifold returns if you're proven right, but it comes with an equally substantial, maybe even higher risk of catastrophic capital loss if buntanetap fails.
Yeah. So as you, the listener, consider Annovis Bio, the ultimate question perhaps isn't just about the detailed science or the specific financials, although those are critical. It boils down to a matter of belief. Do you believe that this small company, Annovis Bio, has finally found the central traffic controller for the brain that literally billions of dollars and decades of research from pharmaceutical giants have missed? Or do you think it's more likely just another promising compound that's ultimately destined for that crowded biotech graveyard? That's the core decision you need to weigh.
That's our deep dive into Annovis Bio, a fascinating, high-stakes situation. We really hope this has given you a clearer, more informed perspective on this unique opportunity and its significant risks. If you found this useful, please remember to like this video and subscribe to the Stock Analytics AI channel for many more deep dives. And don't forget, members get priority access to our big S&P 500 series that's coming up. Plus, you can always drop a super thanks if you want a specific stock analyzed just for you.
And, as always, please remember this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Thanks for joining us for this deep dive. We'll see you next time.